The Quants. How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It, written by Scott Patterson. Summarized by detailed book summaries. Don't forget to subscribe. Chapter 1. All in. Let's start here with the image of a poker table, but not just any poker table. It's a winter evening in February 2007, and we're inside the opulent Four Seasons restaurant in Manhattan. The lighting is elegant, the suits are sharp, the drinks are aged, and the stakes, well, they're not just monetary. This isn't a casual game among friends. This is the gathering of minds that have reshaped Wall Street, mathematical masterminds who've turned code into capital and models into billion-dollar hedge funds. They are known simply as the Quants. Now imagine the tension in the air. Not because someone's about to lose big in the game, but because each man around the table knows that outside these walls the markets are starting to tremble. Mortgage defaults are creeping up. Credit markets are tightening. But inside this room, the atmosphere is relaxed, even cocky. These men trust their models. They've weathered storms before. Their algorithms have delivered year after year. What's a little turbulence to systems designed with precision and run on pure logic? Scott Patterson paints this opening scene like the beginning of a Greek tragedy, where the heroes, still blind to the signs of fate, toast their past victories. Around the table we meet Cliff Asness, the brash, bearded founder of AQR Capital, who married deep value investing with cold, hard statistics. We meet Ken Griffin, the wunderkind founder of Citadel, who once traded convertible bonds from his Harvard dorm room and now commands a multi-billion-dollar empire with the cold intensity of a chess master. There's Peter Muller, the thoughtful, almost mystical head of Morgan Stanley's PDT Group, a man as comfortable playing jazz piano as he is overseeing a labyrinth of trading strategies. And while he's not physically at the table, the name Jim Simons hovers over the scene like a ghost, the elusive mathematician turned billionaire whose medallion fund has become legend, returning unheard of profits year after year from the shadows of Renaissance technologies. These aren't your Gordon Gekko types. They don't rely on gut feelings or rumor mills. They rely on math, on code, on patterns buried in terabytes of market data. In their world, the market is a system, like a complex machine, predictable if you know how to look. They built their careers on this belief, and for decades it worked. Their funds crushed benchmarks. They laughed off Wall Street traditionalists who called them black box traders. They had the numbers. They had the models. And they had each other, often betting against one another but always with the same tools. But here's the question Patterson teases from the shadows. What happens when everyone's using models? What happens when those models start interacting with one another in the real world, not just in code but in live trading with leverage and pressure and panic? What happens when the system, so meticulously modeled, starts feeding back on itself? Because while these men sit comfortably with their wine glasses and poker chips, the world outside is beginning to wobble. The subprime mortgage crisis is not yet front-page news, but the rumblings are there. Collateralized debt obligations are bloated. Lending standards have slipped. Banks are beginning to hoard cash. Volatility is stirring, just below the surface. But in this room, there's no real fear. Not yet. What makes this opening so powerful is that it doesn't scream impending doom. It whispers it. It invites you to witness the calm before the storm, not in the financial pages, but in the body language of men who have grown too comfortable. There's a kind of poetry in how Patterson draws this contrast. The poker game becomes symbolic, a metaphor for the financial system itself. Players bluffing, risking, winning, until eventually someone bets too much, and the table flips. You see, these men didn't just play the market, they became the market. Their trades were so large, so frequent, so interconnected, that their actions influenced prices across asset classes. And because many of their strategies were similar, mean reversion, statistical arbitrage, volatility spreads, they often found themselves crowded into the same trades. Unknowingly, they built a complex, fragile web. One that worked beautifully in stable times, but with little room for surprise. And surprises were coming. The chapter ends with a sense of inevitability. Not doom exactly, but an uneasy clarity that these men, for all their brilliance, are also blind to the very thing they helped create. They're not villains. They're not reckless gamblers. They're scientists, engineers, problem solvers. But in their quest to conquer the markets with math, they forgot something essential. The markets are made of people. And people panic. People overreact. People stampede. No model, no matter how elegant, can contain that kind of chaos forever. So we leave them there in their suits under the chandelier, shuffling cards and sipping drinks, unaware that their models are about to be tested in ways they never imagined, that their faith in logic is about to crash into the raw emotion of a market in crisis, and that when it does, the men who played the system best may end up being the ones caught most off guard. Chapter 2. The Godfather, Ed Thorp. If you wanted to trace the roots of the financial revolution that reshaped Wall Street, not the surface-level greed and glamour, but the real intellectual shift, you wouldn't start with a banker or a broker. You'd start with a gambler, or more precisely, a mathematician who saw gambling not as vice, but as pure, elegant probability, something you could break down, beat, and bend to your advantage. His name was Ed Thorp, and long before hedge funds became synonymous with algorithms and high-frequency trades, Thorp was already doing what seemed impossible, turning games of chance into machines of certainty. He was never flashy. No limousines or penthouses or poker tournaments at the Four Seasons. Instead, Thorp's world was quieter, more precise. His journey began not on the trading floor but at the blackjack tables of Reno and Las Vegas. Picture him there. A quiet professor, glasses perched on his nose, sipping a drink while subtly watching the cards fall. But he wasn't there to play. He was there to test, to observe, and most importantly, to prove a theory. Blackjack, unlike other casino games, could be predicted. Not perfectly, but enough to gain a statistical edge. By tracking the cards played and adjusting bets accordingly, a player could shift the odds. And that player, if they had enough discipline, could walk away a consistent winner. In the early 1960s, this was revolutionary. Casinos thrived on the belief that the house always wins. But Thorp appended that myth with math. He published Beat the Dealer, and almost overnight, card counting became the obsession of aspiring gamblers and the nightmare of pit bosses. But Thorp didn't bask in the glory. For him, the casinos were just a training ground, a test lab for what he really wanted to understand: risk and how to master it. The real game, he realized, was not in blackjack but in the markets. And so he turned his attention to Wall Street. Back then, it was still a place where decisions were made over lunch, where intuition and connections mattered more than computation. But Thorp saw inefficiencies, pricing anomalies in securities that most traders either ignored or didn't understand. Convertible bonds caught his attention, complex hybrids that offered both bond-like security and equity-like upside. Most on Wall Street didn't fully grasp their value. Thorp did. And more importantly, he realized he could exploit the tiny gaps between their theoretical and actual prices by constructing hedged positions, buying the bond, shorting the stock, and reaping the difference as the spread converged. This wasn't trading in the conventional sense. It was arbitrage science engineering, a kind of financial jiu-jitsu that used the market's own momentum against itself. By 1969, Thorp launched Princeton/Newport Partners, one of the earliest quant-driven hedge funds. It was unlike anything Wall Street had seen. No flashy pitches, no seat-of-the-pants bets, just models, systems, probabilities measured to the third decimal place. And the results were staggering. For 20 years, the fund never had a losing quarter. It quietly returned close to 20% annually with remarkably low volatility. In a world addicted to boom and bust, Thorp had built something timeless. And yet, he remained nearly invisible. While others chased fame, Thorp pursued insight. He didn't over-leverage. He didn't court risk for the sake of returns. Instead, he built robust systems and let them work. When market storms came, his strategies held. When bubbles inflated, he stayed grounded. And when regulatory trouble finally brushed against his firm, an entanglement more of association than guilt, he chose to wind things down. He didn't fight. He walked away with his wealth, his record, and his integrity intact. But his influence didn't end there. If Chapter 1 introduced us to the quants of the 2000s, Asness, Griffin, Muller, Simons, then Chapter 2 shows us their intellectual father. Almost all of them owe something to Thorp. Some read his books. Others mimicked his trades. A few, like Jim Simons, took his foundation and pushed it into realms even Thorp hadn't imagined. Yet the blueprint was his. Use math to detect mispricings, build models to exploit them, and control risk with religious precision. There's a quiet poetry to Thorp's story. While others shouted, he whispered. While others took wild swings, he measured every step. And yet, his impact was seismic. He proved that markets weren't just noise, that patterns existed, and that with discipline and intellect, they could be translated into profits. He made the case before anyone else that the market was beatable, not by luck or insider tips, but by cold, elegant math. What made Thorpe special wasn't just his genius, but his restraint. He never let success blind him. He never assumed his models were invincible. He understood that risk is always lurking, even in systems designed to tame it. That humility is rare, especially in finance. And it's perhaps the most enduring part of his legacy. Because while many quants who followed him built fortunes, few kept their footing when the ground began to shift. Thorpe did. Because he never forgot what the casino taught him. The odds can change in an instant, and when they do, the smartest play might be to step away from the table. So while the rest of the book will dive deep into the men who turned Thorpe's ideas into global empires, some rising, some crashing, it's here that we meet the man who saw it all coming. Not because he was lucky, but because he never believed in luck to begin with. Chapter 3. The Poker Face of Wall Street. You know, there's something hypnotic about watching a poker game unfold. Not the ones on television, filled with dramatic camera cuts and booming commentary, but the real ones in small rooms among men who know each other too well. Their faces don't flinch, their fingers don't tremble, and their voices never reveal anything but precision. They're not there for the thrill. They're there for the edge. Now imagine that same group, those same cold-blooded tacticians, trading not in chips, but in billions of dollars. That's where Chapter 3 of the Quants quietly lures you, into a world where poker and finance blur, and the most powerful minds on Wall Street play a game most of us wouldn't dare enter. At the center of this quiet storm is Peter Muller, a man who, by all appearances, shouldn't fit the mold. He's not just a math genius, he's a pianist, a surfer, a man with a spiritual edge. But don't let the gentle exterior fool you. Muller is also the mastermind behind PDT, process-driven trading, a secretive and staggeringly successful quantitative team within Morgan Stanley. His mind dances between harmonic melodies and dense financial models, and somehow he finds poetry in both. But what makes Muller more than just another smart guy on Wall Street is how he operates in this rare intersection of logic and intuition. He doesn't merely use algorithms. He respects them, trusts them, lives by them. And it's in this chapter that Scott Patterson begins to really peel back the human layer behind the quant phenomenon. He paints a picture not just of Muller, but of a broader archetype that was starting to dominate the financial ecosystem. The quant as poker player, the trader as data scientist, the hedge fund manager as a motionless tactician. These men weren't yelling across trading floors anymore. They weren't slamming phones or making big, brash bets based on a hunch. They were listening to the math, letting the code decide, living by probabilities, correlations, and variance. But let's pause for a moment and ask a question. What happens when we allow numbers to replace instinct? Can an algorithm sense fear? Can a model detect panic in the human heart? Can a spreadsheet prepare you for a market that behaves more like a stampede than a machine? That's the subtle unease running under this chapter like a low hum. These poker games that Muller and his quant brethren play, they're not just pastimes. They're reflections. Every hand dealt is a metaphor. Every bluff, every calculated risk, every force fold is a shadow of the trades they place daily. The poker table becomes a mirror of the market. No emotions, just odds, win rate, expected value, risk reward. But the stakes? The stakes are far more than a few thousand in chips. Try hundreds of millions, sometimes billions. And what makes it all so haunting is how calm they are about it. These men, these quants, are building systems that are not just smarter than humans in narrow ways, but faster, quieter, and more precise. Their tools are lines of code. Their weapons are models. Their enemies? Often it's the unpredictable nature of the market itself, or worse, other quants who think the same way. That's the other insight Patterson starts teasing out here. The problem of sameness. You see, it's one thing to have a brilliant trading strategy that mines inefficiencies in the market. It's another when every other genius figures out the same thing and starts trading it too. Suddenly, everyone's bets are lined up like dominoes, waiting for the slightest tremor to bring them all crashing down. The name for that in quant circles is crowded trades. And it's a ticking time bomb. But back to Muller. He, like many of his peers, isn't just running models, he's living inside them. PDT becomes a kind of temple of logic, where every trade is a prayer to the god of probability. There's no room for gut instinct here. No sudden leaps. Just relentless optimization, rigorous testing, and trust in the math. And yet, even Muller can't quite escape the need for balance. He retreats into music, into surfing, into silence. As if even he understands that no machine, no matter how powerful, can survive without a soul behind it. The contrast is striking. On one hand, these men are emotionless, unflinching, dispassionate. On the other, they're human beings quietly wrestling with the pressure of handling sums that could shake economies. It's in those moments, the ones Patterson reveals only subtly, that you see the cracks, the worry, the vulnerability. Because deep down every quant knows, a model is only as good as the assumptions it's built on. And when the world changes, when the data shifts, when fear floods the market faster than any algorithm can predict, even the best models fail. That's the poker face of Wall Street. Calm, calculated, but under the surface, trembling. So what's the takeaway from this chapter, from this quiet immersion into Muller's world? It's not just that quants were changing the way trading was done. It's that they were changing what it meant to be a trader. No longer was success measured by bravado or instinct. It was now earned through discipline, silence, and statistical edge. But that shift came with a cost. The cost of detachment. The cost of believing that the market could be fully tamed, fully modeled, fully understood. And as you close the chapter, there's a lingering sense of unease. Because if all the smartest minds are playing the same game, using the same logic, and placing the same bets, what happens when the deck gets reshuffled? Chapter 4. The Volatility Smile. You know, if you ever had the chance to sit quietly in the back of a room where fortunes are made not through handshakes or gut feelings, but by pure mathematical precision, you'd notice something strange. There's no shouting, no chaos, just quiet intensity. Screens flicker, algorithms hum beneath the surface, and the people running the show barely blink. In Chapter 4 of The Quants, Scott Patterson takes us deeper into this strange new financial universe, and he introduces two titans who didn't just play the game, they reshaped it. One is a former government codebreaker, a math professor turned hedge fund legend named Jim Simons. The other is a young prodigy who transformed a Harvard dorm room into the nucleus of one of the most formidable financial machines in the world, Ken Griffin. Together, their stories don't just describe the rise of quantitative finance. They illustrate how two very different minds, equally brilliant, created systems that would dominate markets and perhaps help break them too. Jim Simons is the kind of figure who makes you wonder what intelligence really means. He didn't come from Wall Street. He came from pure math, abstract, elegant, and entirely disconnected from the emotional noise of financial markets. And yet, that was precisely why he saw something others didn't. While most traders looked for trends with their eyes, Simons believed in the hidden language of numbers, the whispers buried deep within massive data sets. So he started Renaissance Technologies, a secretive hedge fund that operated more like a high-tech research lab than a trading floor. Inside its walls, Simons assembled not traders but scientists, physicists, mathematicians, codebreakers, and cryptographers. They weren't interested in earnings reports or economic news. They were obsessed with patterns, subtle, repeatable, statistically significant anomalies that no human could detect but their algorithms could exploit. It wasn't about predicting the news. It was about reacting to it faster and smarter than anyone else. What made Simons so different wasn't just that he used models. It was that he trusted them more than people. He built systems that could learn from themselves, adjusting to new information in real time, reducing human error one line of code at a time. His team didn't just write models, they cultivated them like living organisms, constantly evolving, constantly optimizing. And the result was the Medallion Fund, a black box masterpiece that would go on to deliver returns so consistent, so outrageous, that they bordered on the mythical over 30% per year after fees for decades. That's not investing. That's rewriting the laws of finance. But Simons never bragged. He didn't talk to the press. He didn't show off. He let the numbers speak, and what they said was simple. We're playing a different game. Now shift your gaze from the quiet halls of Renaissance to the fire of youth inside a Harvard dorm room. There you'll find Ken Griffin, still a student, setting up a satellite dish on the roof so he could access real-time market data. While his classmates were studying for exams, he was trading convertible bonds, executing strategies he had read about, analyzed, and improved upon. It wasn't a hobby, it was an obsession. Griffin didn't just want to understand the market. He wanted to master it. And soon he would. After college, he launched Citadel, a hedge fund built on speed, infrastructure, and total control. Where Simons focused inward, building impenetrable models behind closed doors, Griffin went wide, building an empire, traders, quants, programmers, risk managers, all operating in ruthless, synchronized precision. What made Griffin terrifying to competitors wasn't just his intellect. It was his ability to scale. He didn't dabble, he dominated. He invested in the best talent, the best systems, and most importantly, he designed Citadel to survive anything. Every strategy had a backup. Every risk had a hedge. Every weakness had a fix. It was like watching someone build a skyscraper with earthquake-proof foundations while others were still laying bricks. If Simons was the wizard, Griffin was the general, commanding a digital army across global markets, executing trades with terrifying efficiency. He wasn't just trying to win, he was trying to make sure he couldn't lose. But here's the deeper layer Patterson weaves into this chapter. Not in loud warnings, but in the quiet tension that rises like steam from a machine that's been running too hot for too long. What happens when everyone starts using similar models? What happens when your success becomes the blueprint for the rest of the world? That's the paradox at the heart of Chapter 4. These men were building systems so smart, so effective, that others had no choice but to mimic them. Universities pumped out more PhDs. Funds opened new quant desks. Billions flooded into strategies that were all chasing the same tiny edges. Suddenly, the game wasn't about being the smartest anymore, it was about being the first, the fastest, the last one out before the door slammed shut. And so a quiet danger begins to build. Not from greed or corruption, but from replication. When everyone believes in the same models, the market becomes one giant crowded trade. When one quant fund sneezes, they all catch a cold. And worse, the feedback loops can become vicious. As models react to market moves caused by other models reacting to earlier moves, the system starts to eat itself. It's a loop of logic without a governor. A spiral of precision that forgets chaos is always just one black swan away. But none of that is crashing down yet. Not here. In Chapter 4, we're still at the height of the ascent. The genius of Simons is still unfolding like a blooming equation. Griffin is still rising, building Citadel into a fortress of technology and discipline. The money is pouring in. The returns are dazzling. The risks are buried beneath layers of statistical comfort. And the belief, the quiet faith in the models is unshakable. Yet, as the chapter closes, you feel it. Not in any overt sentence, but in the way the narrative begins to pulse beneath the surface. These systems are magnificent, yes, but they're also delicate. And when you stretch a delicate system too far, no matter how well it was built, it will break. The men behind these machines may be brilliant, disciplined, and visionary. But the market, as we'll soon see, doesn't care how smart you are. It doesn't play fair. It doesn't warn you. Just turns. And when it does, even gods can fall. Chapter 5. 4 of a kind. You know that strange, slightly surreal moment when everything feels just a bit too perfect? That eerie sense that the ground beneath your feet is a little too smooth, the sky a little too clear, the silence a little too loud? That's the emotional undercurrent of Chapter 5. The math is still working. The money is still pouring in. The quants are still kings. But somewhere beneath the smooth hum of the models and the confident forecasts lies the faintest vibration. A whisper that maybe, just maybe, the system they've all come to trust is far more fragile than it looks. By now, the quantitative revolution isn't some fringe experiment run by eccentric math nerds in back rooms. It's the main event. It's Wall Street's crown jewel. Billions, hundreds of billions, are now being managed by machines programmed by PhDs, governed by theories so complex they read like physics papers. And the men behind these machines, Simons, Griffin, Muller, Weinstein, and others, are the new high priests of finance. Investors bow to them. Institutions copy them. Regulators, often a step behind, watch them from a distance, unsure how to even begin to understand what's going on inside these black boxes. Patterson doesn't shove this transformation in your face. He lets you feel it. He lets you see it through the casual way these firms grow, the ease with which they attract capital, the comfort with which they speak about risk, almost as if it's an engineering problem, a mechanical bug to be patched. There's a kind of intoxicating confidence that runs through the streets of Wall Street during this era. And it's not based on greed or recklessness, not in the traditional sense. It's based on something far more seductive, the belief in order, in pattern, in the idea that the chaos of the market can be tamed by logic, contained by models, outwitted by machines. And to be fair, it's hard to argue with success. The returns are astonishing. Quant funds are outperforming nearly everyone. Even as markets wobble, as geopolitical shocks ripple across the globe, these funds remain eerily stable. It's as if they've figured something out that no one else has. Something elemental. Something permanent. That's the illusion, of course. But it doesn't feel like an illusion yet. Feels like revelation. The models grow more complex. The infrastructure more robust. Faster computers, deeper datasets, smarter algorithms. And yet, something subtle starts to shift in the fabric of the market. The models aren't just analyzing trades anymore. They're creating them. The strategies aren't just reacting to market behavior. They're influencing it. You begin to realize that these systems, for all their elegance, are no longer just maps of the territory. They're part of the territory itself. It's like weather models that become so good at predicting storms that they start shaping how cities build, how people travel, how crops are planted. Eventually, the forecast isn't just about the weather, it becomes the weather. And that's where things start to get dangerous. Because if everyone is looking at the same signals, reacting to the same triggers, executing the same types of trades, then the system becomes tightly coupled. Too tightly coupled. A single shock can ripple through the entire structure in milliseconds. That's the hidden vulnerability Patterson begins to expose, not with alarms or flashing lights, but with quiet, careful observation. The quants, in their pursuit of edge, have also created the conditions for collapse. Not intentionally, not maliciously, but inevitably, because systems that are too efficient are also systems that are too brittle. And markets, by their nature, are unpredictable. They are driven by emotion, by fear, by human psychology. And no model, not even the most beautiful one, can fully contain that. Still, in this chapter, no one is running for the exits. There are murmurs, sure. Whispers about crowded trades, about leverage, about the uncanny way so many quant funds seem to be converging on the same ideas. But the money keeps flowing. The systems keep winning. And the belief, that sacred belief in the power of the model, remains unshaken. It's the calm before the storm, though no one quite realizes it yet. Like a perfect cloudless sky on the morning of a hurricane. Everything looks fine. But if you listen closely, really closely, you can hear something underneath the silence. A kind of mathematical tension. A structural hum. Like a machine running too fast, too hot, too close to its breaking point. And as you reach the end of chapter 5, you're not looking at a crash, not yet. What you're looking at is momentum. Momentum towards something no one can fully see. The markets are still efficient. The models are still printing money. But the air feels thinner now. The room a bit tighter. The bridge beneath your feet a little less certain. And still the dance continues. Chapter 6. The Wolf. There's a moment, quiet and eerie, when things start to feel just a little off. You can't quite put your finger on it. The lights are still on, the gears still turning, the music still playing. But something underneath it all has shifted. That's where chapter 6 takes us. We've seen the brilliance of the quants, their rise to dominance, their almost mythological success in turning math into money. But now we enter the moment when the flawless surface of that world begins to ripple. Not crash yet, but ripple. Something deep within the machine is starting to grind, and though no one wants to say it out loud, the system doesn't feel quite right anymore. For years, quant funds had grown fat on their success. The models had worked. The numbers had aligned. The world seemed to move in patterns they could predict and exploit. But as 2007 approached, the cracks, tiny at first, began to show. It wasn't obvious. No sirens, no headlines. Just the occasional unexplained blip in a position. A strategy that had performed flawlessly for years suddenly faltering. Minor losses, strange correlations, puzzling feedback loops. It felt like someone had changed the rules of a game everyone thought they'd already mastered. Patterson doesn't make this feel like a collapse. He makes it feel like a suspense novel. Like a psychological thriller. Because the tension now isn't in what's happening, but in what might be about to happen. Inside firms like Renaissance, Citadel, and AQR, minds sharper than scalpels are analyzing data with growing concern. Not panic yet, but concern. The quant world is built on the assumption that the past can guide the future, that the market, however chaotic, ultimately adheres to probabilistic logic. But now they were staring at anomalies they couldn't explain, risk patterns that didn't match any historical precedent. Some begin to whisper that the models, once so reliable, may no longer reflect reality. Yet the system barrels forward. Capital continues to flow into quant funds. Strategies become more sophisticated but also more complex, more interconnected, more dependent on assumptions that everyone quietly agrees to accept because, well, they've worked before. There's an unspoken agreement among quants that the math still holds, even if a few numbers seem out of place. No one wants to admit they might be flying blind, so they adjust the models. Tweak a coefficient here, a confidence interval there. Trust in the law of large numbers to smooth it all out. But the market has other plans. In August 2007, something strange begins to happen. Quant funds across the board start hemorrhaging money. Not slowly, not incrementally, all at once. Strategies that were completely uncorrelated by design begin to move together, and not in a good way. Trades that were supposed to hedge each other start collapsing in tandem. Firms that had modeled for every possible scenario find themselves exposed to something they never expected. A liquidity event driven by their own kind. It's as if the machine has turned on itself. Algorithms reacting to algorithms. The system eating its own tail. And here's the twist. The panic isn't coming from outside the quant world. It's coming within. It's not retail investors or central banks or rogue traders. It's the quants themselves. Their models are triggering sell orders, stop losses, position unwinds, not because of fear, but because that's what the code tells them to do. That's what the logic demands. And because so many funds are now using similar models, similar risk parameters, similar strategies, they all begin to act in concert without ever talking to each other, without ever meaning to. What was once a competitive advantage, pattern recognition, speed, precision, becomes a systemic weakness. The storm begins to pick up speed. August 7th, August 8th, August 9th. The losses compound. Multibillion-dollar funds are watching their portfolios disintegrate. Patterson makes it feel like a car crash in slow motion, happening too fast to stop, but just slow enough for you to realize with chilling clarity that it's happening. Fund managers stare at screens that no longer make sense. The models don't predict this. They never did. This isn't a market move. This is something else. Something deeper. A feedback loop of quant destruction. And yet, even as the losses mount, there's disbelief. How could the models be wrong? These systems were stress-tested, back-tested, forward-tested. They were the best minds of their generation, the most powerful computers money could buy, the most elegant equations the financial world had ever seen. And now they're all breaking. Together. For the first time in years, the quants feel fear. Not just professional anxiety. Not just portfolio drawdowns. Fear. Because if the models no longer work, if the assumptions no longer hold, then the entire foundation of quant finance begins to feel like a house built on sand. They had created a world where emotion didn't matter, where logic ruled, where markets could be controlled. But now, as the machines sell into weakness, as correlations go haywire, as losses spiral without a human in sight, they are forced to reckon with a truth they'd long kept at bay. No matter how sophisticated the system, it is still vulnerable to panic. And panic, once it begins, doesn't care about logic. The irony is profound. The quants had spent years building tools to manage risk, to eliminate the irrationality of human behavior. And yet, they had inadvertently created a system more tightly wound than ever, one in which the smallest tremor could become an earthquake, amplified not by fear but by math. By the time the chapter closes, the damage is real. Some funds recover. Others do not. There's no catastrophic crash. Not yet. But the spell is broken. The models have faltered. The wizards behind the curtain have been revealed as fallible. And somewhere deep inside the quant universe, a question begins to echo, quiet, persistent, terrifying in its simplicity. What if we've built something we can no longer control? Chapter 7. The Money Grid. There's a strange sense of betrayal that hangs in the air when systems you've trusted, systems you've poured your intellect into, turn against you. Not with malice but with indifference. In Chapter 7, we arrive at that moment of reckoning. The storm that had been swelling just beneath the surface finally makes landfall. But this isn't a thunderous crash with fireworks and breaking news banners. No, the collapse of the quant machine begins with confusion, quiet losses, and the creeping realization that no one is quite in control anymore. It's August 2007, and the most sophisticated trading systems on Earth are eating themselves alive. The quants, those brilliant minds who turn finance into a domain of cold logic and raw computational power, are about to experience something their models never predicted: collective failure. It starts like a ghost in the machine. Models that have worked flawlessly for years begin misfiring. Strategies built on decades of market behavior suddenly yield losses instead of profits. What should be unrelated positions begin moving in tandem, not just in one fund but across many. And these aren't just any funds. These are some of the most powerful names in finance: Renaissance Technologies, Citadel, AQR, and Goldman Sachs Global Alpha Fund. All facing the same inexplicable chaos. The world they engineered, the world they believed they could model, is now twisting in ways they can't comprehend. It becomes clear that what they're witnessing is not a normal market event. This isn't a reaction to a news item or a geopolitical headline. This is something endogenous, a failure generated from within the very strategies that were supposed to eliminate risk. It's like designing a self-driving car that crashes into a wall it was programmed to avoid. The models, following their logic, begin to offload positions to manage losses. But because so many firms are running similar strategies, many built on the same academic research, trained on the same datasets, driven by the same risk constraints, they all start to do the same thing at the same time. And that's when it happens. Like dominoes, one model's panic becomes another's input. What was once diversification becomes a cascade. Funds start dumping positions, not because they've lost faith in the trades, but because the models are triggering autosells to manage rising risk exposure. The problem is, every sell-off triggers further deterioration in price, which trips more alarms, which triggers more sells. The system is locked in a loop. A rational loop. A logical loop. A destructive loop. And here's the cruel irony. The very precision that made these systems so powerful is what makes them so dangerous. There's no room for intuition. No capacity for stepping outside the code. The machines do what they're told, even if it means driving the market straight into the ground. And the humans, those once smug managers who trusted the math, can only watch in disbelief. There's a kind of paralyzed horror that overtakes the quant world. Screens filled with red. Algorithms whirring. Portfolios imploding. And no one can hit stop. Because there is no stop. There's only the logic, unfolding relentlessly. Scott Patterson captures this moment with chilling clarity. He doesn't exaggerate, he doesn't need to. The facts are terrifying enough. In just a few days, quant funds that boasted low volatility, high Sharpe ratios, and decades of unblemished performance lose billions. Global alpha bleeds heavily. Firms that once never saw a drawdown greater than a few percent are suddenly down 20%, 30%, even more. Traders and analysts stare at screens with the same question burning in their minds. What is going on? No one has an answer. The losses defy explanation. The models aren't just wrong, they're dangerous. And the worst part? There's no one to blame. No fraud. No scandal. Just math behaving badly. Behind closed doors, emergency meetings are held. Some firms, like Renaissance, are relatively insulated. Their models are deeper, more proprietary, more opaque. They survive. Others aren't so lucky. Some shut down. Some seek capital infusions. Citadel takes a hit but stands firm, flexing its operational muscle. Goldman Sachs, bleeding from its quantitative exposure, gets a quiet injection of support from none other than Warren Buffett, a reminder that old-fashioned instinct still has its place amid the algorithms. But the damage isn't just in the numbers, it's in the psyche. The faith, the confidence, the arrogance of the quant era has been shaken. These were the men who believed they had conquered chaos, who believed that with enough data, with enough computing power, they could model away risk. But now they see that the models didn't eliminate risk, they redistributed it, amplified it, and then detonated it when conditions turned hostile. The quant quake of 2007 doesn't make front-page news, but in the corridors of power on Wall Street, it is a cataclysm. A foreshock of something far worse on the horizon. And still, in the aftermath, the questions linger. What happened? How could so many independent strategies fail at once? Why did diversification break down? And if this could happen without warning, without any obvious trigger, what does it mean for the entire financial system? The answers don't come easily. In fact, they don't come at all, at least not yet. But one truth has become undeniable. The quants are not immune to collapse. Their systems are not flawless. Their models are not bulletproof. They are human after all, brilliant, yes, but fallible. As the markets settle and the losses are tallied, a new sense of humility begins to take root. Not everywhere, not universally, but somewhere, deep in the hearts of those who lived through the quake, a voice begins to whisper what had once been unthinkable. Maybe we don't understand the system as well as we thought we did. Chapter 8. Living the Dream. There's a kind of deceptive calm that comes after a quake, not because the danger has passed, but because the surface looks still while the fault lines beneath it continue to shift. That's where the world finds itself in Chapter 8. The quant quake of August 2007 had shaken the system, but not shattered it. The hedge funds, though bruised, are still standing. The banks are still operating. The markets, though jittery, haven't yet collapsed. But it's not over. Not even close. Because the real storm, the one that will test the entire architecture of modern finance, is only now beginning to form. And as Patterson slowly draws back the curtain, the mood changes. What was once a story of brilliant minds and elegant models becomes a quiet, creeping tale of fragility, denial, and the terrifying power of unintended consequences. In the aftermath of the quant tremors, a strange mood descends on Wall Street. Some firms retreat, tighten risk, reassess. Others convince themselves it was just a fluke, a moment of market irrationality, not a flaw in the machine. Ken Griffin at Citadel is wounded, but not humbled. He continues to believe in the system. Cliff Asness at AQR does some soul-searching but largely sticks to his convictions. And Goldman Sachs, after a rough few weeks, absorbs its losses, adjusts its positions and moves on. But none of them can quite explain what happened. Not fully. The data doesn't add up. The models don't clarify. What they saw in August defied their assumptions, violated their equations, and yet they push forward, driven by momentum, by pressure, by belief. Meanwhile, a darker force is quietly gathering strength beneath the surface. It starts in the housing market, where subprime mortgages, those risky loans handed out during the boom like party favors, are starting to rot. Defaults are rising. Home values are sliding. But no one is ready to call it a crisis. After all, the system is hedged. That's what they tell themselves. Credit default swaps are in place. Securitization has spread the risk. The damage will be contained. That word, contained, echoes through the chapter like a warning no one hears. Because what no one wants to admit is that the entire financial ecosystem is now soaked in these toxic mortgage-backed securities. Banks, hedge funds, insurance companies, pension funds, all of them are exposed. And the models they used to price this risk? Built on data from an era that no longer exists. The quants, ironically, are both victims and accomplices. Their models helped fuel the rise of structured finance. They provided the mathematical backbone that made it all seem safe. They were the ones who assured the world that tranching subprime debt, slicing it into investment-grade layers, reduced overall risk. But what the models didn't account for was a total loss of trust. The kind of psychological unraveling that can't be quantified. Because when investors begin to question the value of these complex instruments, when banks stop trusting each other, liquidity dries up. And once liquidity dries up, even the safest assets can become radioactive. Patterson captures this transition with chilling clarity. There's no singular event that marks the collapse. It happens in stages. A little tremor here. A missed payment there. A hedge fund quietly closes. A bank adjusts its exposure. But the signs are multiplying. And the interconnections, those hidden pipes linking quant funds to investment banks, linking mortgage-backed securities to global portfolios, begin to buckle under the pressure. What's most unsettling is the absence of a single villain. No one set out to create this disaster. It was built piece by piece, trade by trade, assumption by assumption. Everyone thought they were managing their slice of risk. No one realized they had all built their houses on the same sinking sand. And amid all this, the belief in the models persists. There's something tragic in that. The quants, many of whom are deeply rational people, still trust their code. They believe the chaos will correct itself, that the market, like any good system, will return to equilibrium. But the market isn't a system anymore, not in the traditional sense. It's a machine with too many inputs, too many feedback loops, too much noise. It's no longer responding to fundamentals. It's responding to fear. And fear, unlike volatility, cannot be predicted. As the chapter unfolds, you feel the walls closing in. Not dramatically, but steadily. Banks begin to hoard cash. Interbank lending seizes up. The repo markets grow tense. And through it all, the regulators remain eerily calm. The Fed offers soothing words. Treasury officials speak of confidence. But behind the scenes, everyone is beginning to realize the same thing. Something is very wrong, and no one knows how to stop it. By the end of the chapter, the air is thick with foreboding. The storm hasn't hit yet, but the sky has turned. The models have failed to predict the gathering clouds. The quants, once hailed as the future of finance, now find themselves tethered to a machine that's begun to move without them. Faster, wilder, more erratic than anything they'd ever seen. And deep down they know. The quant quake wasn't the end. It was just the start of the unraveling. Chapter 9. I keep my fingers crossed for the future. It's strange how the end of something so enormous can begin in such a quiet, almost unremarkable way. One trade goes bad. One counterparty stops returning calls. One phone line goes silent. And then suddenly the entire room feels colder. In Chapter 9 we arrive at that moment. Not with a scream but with a slow, smothering gasp. The systems that powered the golden age of the quants, the algorithms that once danced through billions of trades with surgical precision, are now short-circuiting in the dark. The world they thought they understood, down to the decimal, down to the millisecond, is coming undone. And what's worse, they saw it happening and they couldn't stop it. By early 2008, there's no longer any illusion that the problem is isolated. The ripples from the quant quake have grown into waves, and now those waves are rising into a wall of water. The collapse of Bear Stearns is the clearest sign yet that the storm isn't over. It's just getting started. The firm's overexposure to toxic mortgage-backed securities, once dismissed as a manageable risk, now becomes the catalyst for a full-blown liquidity crisis. Markets begin to seize. Banks start hoarding capital. And in that frozen silence, trust vanishes. Not just between firms but between people, between trader and trader, between the model and the one who built it. For the quants, this isn't just a financial crisis. It's personal. Their models weren't supposed to behave this way. They were tested, back-tested, stress-tested. They had weathered recessions, rate hikes, market noise. But the assumptions, the very core beliefs that made those models possible, have been shattered. The idea that markets are efficient, that risk is quantifiable, that diversification is a shield. All of it has melted away in the face of cascading failure. And now, even the most brilliant minds in finance are forced to confront a terrifying truth. They didn't understand the system nearly as well as they thought. Scott Patterson takes us inside the hearts and minds of these fallen wizards, not to mock them, but to show us the fragility beneath their brilliance. Men like Ken Griffin, Cliff Asness, and others had built empires on mathematical elegance. They had convinced the world, and perhaps themselves, that they could see farther, act faster, and think more clearly than anyone else. But now those same models are betraying them. And in the chaos, it's no longer about managing risk. It's about surviving it. Everywhere, the damage is accelerating. Credit markets dry up. Collateral becomes suspect. Trades once assumed to be safe explode with unforeseen volatility. Algorithms, sensing risk, begin dumping positions automatically. But in doing so, they feed the panic. The market isn't just falling. It's consuming itself. Feedback loops spiral into disaster. A trade that should have lost a fraction of a percent suddenly tanks a portfolio by 10%. Strategies that once thrived on slight imbalances now find themselves suffocated by symmetry, because everyone else is trying to do the same thing, at the same time in the same way. And in the midst of it all, no one can find the off switch. That's the most chilling part. These models, these systems, these self-fulfilling machines of prediction and execution, weren't designed with panic in mind. They were built for a world of probabilities, not possibilities. And now that possibility of mass failure, of total contagion, is no longer abstract. It's real. It's happening. There's a devastating irony in it all. The very sophistication that made the quant era so powerful is what made it so vulnerable. The strategies were so tightly engineered, the trades so carefully hedged, that they left no room for improvisation, no space for human judgment. When the world veered off course, the machines just kept marching, straight into the abyss. And the quants, watching from their screens, understood exactly what was happening, but were powerless to override it. The math said sell. The model said unwind. And the system, like a train on greased rails, could not be stopped. What emerges in these pages isn't just a chronicle of financial collapse. It's a kind of tragic realization, almost Shakespearean in its scope, that genius alone is not enough, that the illusion of control, no matter how elegant, is still just an illusion. The markets aren't physics. They're not particles. They're not bound by equations. They're made of people, fear, memory, and herd behavior. The quants had tried to remove the messiness. They tried to build a financial world free from emotion. But they forgot that systems built by humans, even those run by machines, still bleed human bias. And as 2008 moves forward, with Lehman teetering, with the global economy gasping, with hedge funds imploding by the dozens, the survivors of the quant age are left not with answers, but with 1,000 hard questions. Was it hubris? Was it the code? Was it the blind faith in models? Or was it simply that no system, no matter how intricate, can truly predict the unpredictable? The final chapters of this financial tragedy aren't written in formulas. They're written in the stunned faces of fund managers who once believed they had cracked the code to wealth, only to find themselves just as human, just as vulnerable as the rest of us. By the end of Chapter 9, the market hasn't fully collapsed yet, but the narrative has. The story that the quants told the world, that with enough math you could master risk, is now a cautionary tale. The silence that follows isn't the calm of recovery. It's the silence of disbelief, of reckoning, of men sitting alone in glass towers, staring at screens that no longer hold any answers. Chapter 10. The August Factor. There is a strange and solemn kind of silence that follows a cataclysm, not the kind born of peace but of exhaustion. After the wild chaos of 2008, when the models cracked and the money bled and even the quants began to question their machines, Chapter 10 opens in that eerie stillness. The dust has begun to settle, but the damage is irreversible. The world has changed, and though buildings still stand, the confidence in them has vanished. The quants, those brilliant minds who once wielded algorithms like swords, who danced with data through every flicker of market movement, are no longer gods. They're men. Men who've been humbled. In the corridors of Wall Street, the tone is subdued. Gone are the grand promises and swaggering projections. In their place, audits, investigations, meetings shrouded in discomfort. Everyone is asking what went wrong, and no one has a satisfying answer. Not the bankers, not the traders, not the quants. The models had worked until they didn't. They had predicted thousands of outcomes, but not this one. Not the cascading fear. Not the collapse of liquidity. Not the simultaneous failure of every assumption that once felt bulletproof. Risk wasn't eliminated. It was disguised, pulled into dark corners, magnified by leverage. And the ones who'd built the most sophisticated systems on Earth to guard against it had not just missed it, they'd helped create it. Jim Simons at Renaissance emerged largely untouched, his medallion fund shielded by a secrecy so intense that even other quants could only speculate about its methods. He had always played a different game. More opaque, more adaptive, more self-aware. But for others, the scars were deep. Ken Griffin at Citadel fought hard to keep his empire afloat, and he succeeded, but not without taking a beating. Cliff Asness at AQR took the loss like a blow to the chest, responding with reflection and fierce writing, trying to defend the quantitative philosophy while still accepting its flaws. Others simply disappeared. Their funds folded into history with little more than footnotes and regrets. And yet, for all the damage, for all the disillusionment, something odd begins to stir in the ruins. Not arrogance, not denial, but curiosity. The story doesn't end in total ruin. The markets don't vanish. Capital doesn't dry up forever. Life continues, albeit slower, more careful, more guarded. In the quiet that follows the storm, some of the quants begin to rebuild, not just their models but their understanding of what models are. They begin to grasp that math is powerful but not omniscient. That data is rich but never complete. That markets are not machines, they are organisms. And in organisms, things mutate. Emotions matter. History echoes. The quants, at their core, never stopped believing in analysis. But now they question which analysis. They begin to layer their code with more caution, more flexibility. They pay closer attention to liquidity, to leverage, to fat tails. They still use algorithms, but they begin to place more value on intuition, on understanding the system beyond the spreadsheet. The smartest ones don't throw away their tools. They simply start wielding them with a different kind of respect. And as they rebuild, the regulators arrive, too late, but here nonetheless. Dodd-Frank is drafted. Stress tests are introduced. Risk committees are empowered. Complexity is no longer celebrated. It's scrutinized. And though the changes don't fix everything, they mark a shift. The beginning of a new kind of awareness, one in which models are seen not as solutions, but as maps. And maps, no matter how detailed, are never the same as the territory. Patterson doesn't end the book with answers. He ends it with a mirror. What began as a story of triumph and mastery becomes a meditation on limits, of knowledge, of prediction, of human ambition. The quants didn't fail because they weren't smart enough. They failed because the world they tried to master refused to be reduced. In trying to turn the market into an equation, they missed the essence of what made it dangerous and beautiful. Its unpredictability, its irrationality, its humanness. And so the final scene is not a crash, not a redemption, not even a warning. It's a single figure, real or imagined, sitting in front of a monitor, staring at a blinking cursor, the glow of numbers reflected in tired eyes. A new line of code is waiting to be written. A new model is being drafted. But something is different now. Not in the math. In the man. Because now, he knows what the last one didn't. Chapter 11. The Doomsday Clock. In the uneasy stillness that follows a crisis, there's a different kind of noise, quieter, yes, but heavier. The clinking of coffee mugs at meetings that now feel like confessions. The rustle of financial statements that have morphed from trophies into autopsy reports. The barely audible tension in conversations once laced with confidence. Chapter 11 opens in that thick air of post-meltdown soul-searching, where the quants, those masters of abstraction, the lords of logic, have been stripped of their cloaks and are now left to stare at the wreckage of the machine they helped build. And what stares back isn't just a broken system. It's the reflection of a blind spot they never thought they had. The dream had been intoxicating that through numbers you could master chaos. That markets, no matter how vast or volatile, could be reduced to elegant functions. That risk could be measured like weight, trimmed like fat, managed like code. But that dream, like so many others in the winter of 2008, has cracked. The public is furious. Congress is circling. Journalists are digging. The facade of silent genius is no longer enough. The question now isn't how the models worked, but why they failed. Why they failed so dramatically, so quickly, and so universally. The quants aren't just running simulations anymore. They're answering subpoenas. And in the process, they're confronting something far more difficult than volatility. Self-doubt. And yet, it's not a trial in the classical sense. There's no singular villain to blame. The catastrophe wasn't orchestrated by one evil genius pulling levers behind the curtain. It was more insidious than that. It was systemic, distributed, built into the logic of the market itself. Magnified by leverage, interconnection, and faith. The same faith that had once seemed rational. Optimizing for returns made perfect sense. Until the system was optimized into a corner it couldn't escape. And the brilliance that once allowed quants to capture 0.1% on billions of dollars now looked like the blade of a machine with no off switch. Precision without perspective. But something else is happening now, slowly, subtly. Amid the blame and the resignations and the soul-searching, there's also a pivot. The smartest survivors are recalibrating not just their models but their mindset. They're beginning to understand that uncertainty isn't a problem to be solved, but a terrain to be navigated. That risk doesn't exist in a vacuum. It's always human. Always tied to fear, to trust, to politics, to crowd behavior. And the models, for all their mathematical integrity, had missed that completely. Still, the financial world doesn't stop. It never does. Even as reforms are drafted and oversight is tightened, the markets hum back to life. Quants don't disappear. In fact, in some ways they become more vital than ever. Because speed, complexity, and automation aren't going away, they're accelerating. But now a shadow lingers behind every formula, a question behind every assumption. The crisis has installed a kind of second voice in the minds of even the most confident algorithm builders. A whisper that says, "What if we're wrong?" And that whisper is powerful. It's what begins to reshape not just the quants but the institutions around them. Risk managers are no longer just compliance officers, they become gatekeepers. Stress testing becomes not just a bureaucratic hurdle, but a moral imperative. And suddenly, the most forward-thinking quant funds are those that bake humility into their code, that allow for doubt, that leave room for chaos, not to be controlled but to be respected. By the end of the chapter, the world hasn't healed, but it's begun to rethink. The crisis didn't kill the quants, but it changed them. It humbled them. It reminded them that the markets are not a closed system. They are not physics. They are not chess. They are something far more fragile, far more erratic, and far more human than any formula can fully contain. Some of the original players remain older, wearier, wiser. Some fade out quietly without a headline. Others double down, more careful but no less committed. And in offices across New York, Chicago, London, Singapore, the screens light up again. The algorithms tick. The data flows. But now, somewhere in the background of all that speed and certainty, there's a pause. A breath. A long, invisible footnote that reminds them all, however brilliant the system may seem, it is only as strong as its understanding of what it cannot control. Chapter 12. Flaw. After the dust settles, after the headlines fade and the markets begin to hum again with a cautious rhythm, what remains is not victory or failure, but something far more elusive, the truth. Chapter 12 drifts into that aftermath, into the quiet spaces left behind by the storm. The world didn't end. Wall Street didn't vanish, but everything feels different now. There's a weariness in the way trades are placed, a subtle hesitation in the algorithms, a kind of shadow that wasn't there before. The quants, once heralded as the future of finance, have emerged not as villains, not even as heroes, but as cautionary figures, symbols of what happens when intelligence is mistaken for invincibility. What strikes most in these final chapters isn't the sound of collapse, but the silence that follows it. Gone are the frenzied trades, the roaring hedge fund conferences, the confident forecasts. What's left is reflection. Across boardrooms, trading desks, and government panels, the financial world is now asking the questions it should have asked long before the crash. How did we let the models blind us? Why did we believe systems so rigid could survive a world so volatile? How did we convince ourselves that numbers were truth and that markets would behave? Jim Simons remains a specter in the background, his Renaissance technologies weathering the chaos better than most, guarded by secrecy, by rigorous testing, by a refusal to fall in line with the broader herd. Others were not so lucky. Cliff Asness, bruised but unbroken, continues to write and reflect, searching for a reconciliation between faith and data and the need for discretion. Ken Griffin survives too, shaken yet determined, adjusting strategies, rebuilding trust, never fully conceding but clearly changed. These figures don't vanish, they adapt. But around them the terrain shifts. The post-crisis financial world no longer worships the quant with uncritical awe. Regulators are no longer hands-off. Investors are no longer naive. And the quants themselves, those who remain, move with more caution, more self-awareness. They begin to understand what the crisis exposed so brutally, that financial systems are not closed circuits of logic. They are open systems susceptible to panic, politics, psychology, and the unpredictable actions of millions of fallible human beings. That recognition doesn't kill quantitative finance, it matures it. In that way, the collapse becomes a kind of crucible. A generation of mathematicians, physicists, and data scientists who once approached markets like equations now begin to see them as ecosystems, dynamic, messy, deeply human. The math remains, but it walks alongside humility now. Risk isn't just a number. It's a story, a behavior, a memory. And the best quants begin to design models not just for ideal conditions but for the unthinkable. For liquidity vanishing. For prices collapsing. For everyone running for the door at once. And yet, there's no grand transformation. No clean break from the past. The machines still run. The high-frequency trades still pulse through fiber optic cables. New funds open, often started by the same players who lived through the meltdown. The incentives of the industry haven't changed entirely. Greed hasn't disappeared, nor has ambition. But something quieter has taken root. A whisper in the back of the mind, a second-guessing instinct, a recognition that even the most brilliant model is only as good as its assumptions. And assumptions by their nature are fragile. That fragility becomes the lasting lesson. Not that quants were wrong to trust in numbers, but that they were wrong to trust only in numbers. The models, in the end, were never the enemy. The real danger was the certainty, the idea that with enough processing power, with enough historical data, you could control the uncontrollable. That belief is what unraveled when the market turned against itself. That belief is what turned a handful of bad trades into a worldwide panic. And so Chapter 12 closes not with judgment, but with understanding. The quants who survived carry with them a deeper sense of what markets are. Living things, chaotic things. Things that defy even the most elegant logic. They still write code. They still build algorithms. But now they leave space in the system for randomness, for fear, for failure. They build not to conquer uncertainty, but to coexist with it. And maybe that's the most important evolution of all. Chapter 13. The Devil Work. By now, the glow of the pre-crisis world has long faded. The headlines have changed. The panic has receded into the shadows of the past. But in the offices where glass walls once reflected overconfidence and digital dashboards blinked with certainty, something quieter, more permanent, has taken hold. There is no longer the rush to innovate without reflection, nor the euphoria of outpacing the market with clever code. What remains is something more human. A long exhale. A slow, sobering gaze toward what's left, and what must be rebuilt differently. Chapter 13 unfolds in this aftermath, where the quants still walk the halls of finance, but with their confidence tempered by history and humility. The system didn't collapse entirely, but its myths did. And those myths of perfect risk models, of limitless leverage buffered by mathematical ingenuity, of rational markets managed by rational minds, lie broken beneath the surface. Yet the world continues to turn. Capital still flows. Funds still run. And the quants, though chastened, have not disappeared. In fact, their presence has multiplied. Across the globe, hedge funds, investment banks, and asset managers still recruit the brightest minds in physics, engineering, and mathematics, pulling in a new generation of quantitative talent. These new quants, however, arrive into a different atmosphere. The warnings are now embedded in the walls. The scars of 2008 are part of the furniture. The models have not been abandoned, but they are now viewed with a skeptical eye. Some of the original pioneers are still in play. Ken Griffin, battle-worn but relentlessly strategic, continues to build Citadel into a financial powerhouse, not by abandoning quants, but by demanding more from them. More transparency, more accountability, more understanding of the edge between logic and arrogance. Cliff Asness at Acor carries on, thoughtful as ever, but no longer under the illusion that correlation can always be trusted or that volatility can be tamed indefinitely. He continues to write, to defend, to explore. And Jim Simons, elusive, elegant, impenetrable, remains the enigma. His firm, Renaissance Technologies, somehow navigated the carnage with quiet brilliance, protected not just by its code, but by its culture of relentless curiosity and ruthless skepticism. They tested, they doubted, they adapted. And it paid off. Yet for every survivor, there were many more who did not make it. Small funds vanished. Promising strategies imploded. Careers ended not in disgrace but in silence. The crisis didn't need to vilify anyone. It simply rendered the overconfident obsolete. And now a new question looms over the world they've left behind. Not whether quants are still relevant, but whether they've truly learned. Not just how to model risk, but how to live with it. Because the risk is no longer just financial. It's existential. The algorithms have only grown faster. The systems more intricate. Artificial intelligence, machine learning, and massive data harvesting now push the frontier of finance even further from human intuition. And in that speed, that complexity, lurks a quiet fear. What happens when the systems evolve beyond our capacity to oversee them? What happens when the next crash is no longer a human failure, but a systemic misfire triggered by code we barely understand? Chapter 13 doesn't answer that. It doesn't try to. Instead, it drifts into the present, where young quants now study the mistakes of their predecessors not just as academic exercises, but as parables. A new generation sits before banks of monitors, armed with Python scripts and market feeds, running simulations designed to outthink everyone else. But somewhere in that noise, they've heard the echo of 2008. They've seen the graphs that didn't predict what mattered. They've read the papers that missed the panic. And they've begun to grasp what the earlier quants learned the hard way: that models are only as useful as the humility of their creators. And so this chapter settles not into triumph, but into vigilance. There is no final formula, no algorithm to fix the human element. But there is a chance, a quiet, persistent chance to do things better, to build models that question themselves, to pair brilliance with restraint, to remember that financial systems, no matter how complex, are still powered by emotion, by fear, by collective memory. The quants are still here. Their screens still glow. Their numbers still run. But now beneath it all is a pause, a breath, a kind of wisdom forged not in success, but in survival. Chapter 14. Dark Pools. In the end, there are no explosions, no dramatic collapses or triumphant redemptions. Just silence, the kind that comes after the questions have been asked, after the systems have been stress tested, after the dreams have burned down into something smaller, more cautious, more aware. Chapter 14 doesn't shout. It whispers. It doesn't rush to conclusions. It lingers in the uneasy space between what was learned and what still remains uncertain. The world of the quants didn't end with the crash. It endured. But not without change. What remains is a landscape that looks similar on the surface: hedge funds humming with activity, algorithms blinking across dark screens, young PhDs poring over stochastic models and execution strategies. But beneath that surface is a new tension, a realization that nothing, not even the most sophisticated model, is immune to collapse. The survivors know this. They carry the weight of what happened not like a wound, but like a scar, healed but sensitive. They've stopped pretending that finance is pure math. They've stopped believing that the market can be reduced to logic. And they've started accepting something far harder to model: human behavior. The crash had taught them that markets are not machines, they are ecosystems. And when too many players start behaving the same way, driven by the same models, responding to the same signals, the illusion of diversification vanishes. What seemed like safety was really correlation. What felt like control was just timing. Until it wasn't. And when the tide turned, it did so all at once. There was no chance to adjust, no margin to maneuver. It was the cold, mechanical cascade of systems feeding on each other, amplified by speed, driven by fear. But even then, the response wasn't to abandon models. The quants didn't throw away their code or flee the industry. They evolved. They began embedding risk measures not just into their portfolios but into their thinking. They stopped trying to outsmart randomness and started designing systems that could survive it. They understood, finally, that models aren't answers. They're approximations. And the best models are the ones that assume they'll eventually fail. It's not just a technical shift. It's a cultural one. Firms that once prized secrecy above all began to talk more openly about risk. Regulators stepped in, not to destroy innovation, but to slow it down just enough to breathe. Conversations about liquidity, leverage, and systemic fragility became part of the daily language of finance, no longer confined to obscure footnotes or academic journals. Risk managers gained new authority. Compliance officers weren't just box checkers, they were firewalls. And yet, as Patterson gently reminds us, the danger hasn't disappeared. If anything, it's grown more subtle. The systems are faster now, the models more complex, the data deeper. And while the scars of 2008 may have faded in public memory, in the backrooms of Wall Street, they're still being studied like ancient battle maps. The young quants who enter the industry today weren't there when the walls came down. But they inherit the consequences. They train on the ruins. They write code that attempts to remember what they never lived through. There's something haunting about that. A kind of fragile continuity. The idea that finance, for all its evolution, is still chasing the same old dream. That with enough intelligence, enough speed, enough precision, we might finally master the chaos. But now, perhaps there's a little more humility in the pursuit. A sense that mastery isn't the goal. Survival is. Sustainability is. Understanding the limits is. And so the story ends not with a period, but with an ellipsis. The quants remain. The markets continue. The models run. But somewhere in every risk projection, in every line of code, in every quiet conversation over spreadsheets and coffee cups, there's a pause, a breath, a single sobering awareness that the next crisis, if it comes, will not ask permission, and that the only real advantage is not certainty but doubt, the kind of doubt that keeps you questioning, refining, stepping back when everyone else is charging forward, the kind that doesn't paralyze you but protects you. In the glow of the screens, beneath the hum of algorithms, finance marches on. But now the best minds don't ask how to outsmart the market. They ask how not to underestimate it. And maybe that's what survival looks like in the age of quants, not perfect trades but wiser ones. The data deeper. And while the scars of 2008 may have faded in public memory, in the backrooms of Wall Street, they're still being studied like ancient battle maps. The young quants who enter the industry today weren't there when the walls came down, but they inherit the consequences. They train on the ruins. They write code that attempts to remember what they never lived through. There's something haunting about that. A kind of fragile continuity. The idea that finance, for all its evolution, is still chasing the same old dream. That with enough intelligence, enough speed, enough precision, we might finally master the chaos. But now, perhaps, there's a little more humility in the pursuit. A sense that mastery isn't the goal. Survival is. Sustainability is. Understanding the limits is. And so the story ends not with a period, but with an ellipsis. The quants remain. The markets continue. The models run. But somewhere in every risk projection, in every line of code, in every quiet conversation over spreadsheets and coffee cups, there's a pause, a breath, a single sobering awareness that the next crisis, if it comes, will not ask permission, and that the only real advantage is not certainty but doubt, the kind of doubt that keeps you questioning, refining, stepping back when everyone else is charging forward. The kind that doesn't paralyze you but protects you. In the glow of the screens, beneath the hum of algorithms, finance marches on. But now the best minds don't ask how to outsmart the market. They ask how not to underestimate it. And maybe that's what survival looks like in the age of quants. Not perfect trades but wiser ones.